red
Okay.
frame. That's my guess.
So JR and I are here today to discuss the 5 smart investing strategies, and we're glad you're joining us. So for starters, I'm Ryan Van Buren. I've been an investment advisor for 26 some odd years. I have a CFP, and this is JR. He's one of our financial advisors here at One Overview, where our model is to simplify money and live your life, and to live your life. A little bit about our background. We are a firm that believes in educating. We're a curious firm. We are committed to helping people save for retirement and to keep their money in simple and growing, and be long-term with their investments. We're going to talk today about 5 smart investing strategies. The first is don't time the market. The second is asset allocation. Third is investment selection, dollar cost averaging, and rebalancing your portfolio. JR, you want to cover the first one for us?
I'd love to cover the first one, Ryan. Thank you. I spent a lot of time in investment publishing. I did some speculative trading, guiding some self-directed investors, and this was a huge piece of what I was always trying to talk about with those guys who wanted to get in there and do the trading themselves and try to time the market. The thing is, you can look at this little chart and you can know exactly when to buy and exactly when to sell. Just turns out usually investors, novice investors will do the exact opposite, right? And that's because there's all kinds of biases coming into play, fears coming into play, to where you think you're smarter than you actually are, or you're more scared than you actually should be.
Right.
And so these emotions and this psychology comes into play, where we see people running when they should be buying, people selling when they should be buying, and buying when they should be selling.
Kind of that fear, greed, and they move from both extremes because they're trying to time the market.
Absolutely. The real investors, the ones who have lots of money, have deep pockets, they're capitalizing off this fear and greed cycle, because they know who's selling and they know they want to be buying that fear.
So what happens if clients try to time the market? For instance, as you can see in this slide here, I'll cover this one. If you stay the course, this is an example, and just because it's an effective example, it includes the bottom of a market, which is 2022. You invested all days, including the downturn year of 2022. You still ended up with a 9.8% return. But you missed just the best 10 days and your performance drops to 5.6. You miss the best 60 days out of that time period, 20 years. You actually have a negative return, 93% lower than the best 60 days are a miss. So it's all about not missing the market, staying in the course.
That's pretty incredible, right? I mean, that's the worst stat to hear when you think you can time the market.
I hear it all the time, and I always tell clients it's hard to do because you got to be right twice. You got to be able to get out of the top and get back in on the bottom, and rarely does someone get right either one, let alone both. So that's a big thing. What about asset allocation?
Yeah, I mean, this is certainly a fundamental piece of investing. Trying to put yourself in the places that spread out the risk, the things that avoid the biggest risk, avoid the biggest extremes. So understanding asset allocation, putting pieces of money in one bucket, pieces of money in another bucket, is critical, for long longevity, for investing over the long term. It's easy to think I'm just going to put my money in the most speculative assets, and then the next thing you know, you've lost half your money in a day, and you're running for cover.
These kind of go hand in hand with the timing thing, because I'll constantly hear people say, I want to be in this particular fund, but I mean, the data's there. 91, almost 92% of all performance is just being in the right asset allocation, not trying to be in necessarily the right fund. And to go along with that, I'm just going to slide that little mouse of ours over a little bit. is I get it there. I'm getting it there. Sorry. Is, it's getting the right allocation between the normal. So you mentioned speculative. Sure, it can be part of a portfolio, but don't chase there. There's other asset classes, and those are cash equivalents, fixed income, bonds, stocks. They all have an important place, don't they?
Absolutely. And knowing where you belong, when you belong there, is key.
Look at long term. I mean, this is just a perspective, and obviously you can see, obviously, but is if someone has $10,000 in over a time period of 20 years, how much greater, even with the ups and downs, what stocks did versus bonds versus cash. And I like that we're looking at this in including the downturn in 2022, because that it's easy to just say, look how good it's been the last 2 years. It really needs to be looked at over a longer period of time. Cash doesn't keep up. Bonds don't keep up. Stocks are a big player when you go long term.
Absolutely.
Yeah.
There's no other game in town, as they say.
Yeah. And I think this slide kind of goes into it. Stocks typically outpace the gains from both bonds and cash equivalents. You can see cash did outperform 2 out of those years. Bonds only 1, but stocks over and over again. That doesn't mean cash doesn't have a part of your portfolio, but it needs to be taken into perspective. What about dollar cost averaging? How does that as a good one of our 5 strategies? How does that work?
I think it's one of those things that if you can sort of set it and forget it, the market, the volatility is going to kind of be your friend over time, right? For those short-term traders who want to time the market, volatility is perhaps their worst enemy unless they're actually trying to trade the volatility and capitalize. That's for the professional investors to manipulate, not to manipulate, but to exploit the novice investors. But dollar cost averaging over time is just going to allow you to be buying more shares and building up your inventory of stocks, and ultimately giving you a much greater pot at the end of the day.
Even in a falling market, it can soften the blow of things going down, and as well as in a rising market, it can get you a better price as well. It's not a perfect strategy, but dollar cost averaging, you're putting in a little bit at a time, and you can end up getting a better price, because when the market's down, you're buying more shares. When the market's up, you're buying less shares. So you're dollar cost averaging in and getting a better situation. I know we talk about this, but sometimes we talk about dislocation, but sometimes people don't rebalance their portfolio. Shouldn't they maybe consider that as like a conservative investor needs to be careful to not be too heavy in stocks? Maybe they need to be 30% stocks, 7% bond. That's not perfect, but they need to decide that, hey, am I a conservative investor? Am I a aggressive investor? Do they have the stomach for that? Because the average returns over that time period were maybe 7, but if they were aggressive, they could have made 9% in those 97-year periods. And then it really depends also that they need a rebalance, which means it's not fixed, it's dynamic. It needs every, at least, I would say at least once a year, you rebalance the portfolio. Sometimes more, but you got to be careful of taxes sometimes, right?
Yeah, I think that's standard practice, good practice. And ultimately it goes back to those questions, where should I be and when should I be there? And so understanding your investment horizon, your timeline, what kind of money you have in the market, what type of liquidity needs you have, will influence how you are balancing your portfolio. And then, of course, that rebalancing comes into play in sort of a strategic or maybe even a tactical way, from year to year.
Yeah. I put this out there to clients to kind of think about this, or prospects too. I don't always know that my clients know where their money is. So I sometimes will ask them, well, where is your money? Do you have everything, your banking, checking, savings? Do you have bonds? Do you have fixed income? Wait a minute, aren't those the same? Not necessarily. It could be a fixed annuity. It could be sometimes people consider real estate fixed income. I would never. It could be in stocks. It could be speculative. You need to know where your money's at, and make sure it's matched up to your goals, your risk tolerance, and your time horizon. All 3. Let's maybe put this to a thought. There are other strategies, right? But these are 5 very simple, very smart investment strategies. What's some questions that maybe people should consider, or of your own that you would think of?
Well, I would say, I would agree. Obviously, these are time tested. But the thing is, they are hard to do if emotions come into play, right? When people's money is on the line, the emotions come into play. That's when the market timing falls apart. That's when people get desperate. They start taking risks that they shouldn't be taking. So as easy as it is to point to these tried and true investing strategies, it's sometimes typically for the average investor a lot harder to execute and stay disciplined in. That's why really it's about reminding ourselves of this, reminding our clients of this.
It is, and it's sound investing strategy, simple stuff. And in our long-term picture, it's our mantra, and hopefully you're not seeing this upside down, but it's simplify money, live your life. We want to keep it simple so you can live your life and enjoy it. So we're here at One Overview, want to start these videos off, and we thank you for the time, and there's our thank you slide. Regardless, if you need help or have questions, please reach out to our office for more information. We're glad that you were part of this. Thank you.